All right, class, welcome. Today, we're diving into a really powerful tool that you'll definitely encounter in your careers. It's the Section 217 election for non-residents. Now, getting this right can mean the difference between a client overpaying their taxes and you getting them a really nice, unexpected refund. So let's break down exactly how this whole thing works. So here's our game plan. We're going to start by looking at the default tax problem that a lot of non-residents run into. Then, we'll introduce the solution, which is, of course, the Section 217 election. From there, we'll get into the nitty-gritty, how you decide if it's the right move, the mechanics of how to file, and a critical rule you absolutely cannot forget.
Okay, let's get right into it. To really appreciate why Section 217 is so valuable, you have to understand the standard situation, the default problem. What happens when a non-resident earns certain types of income from a Canadian source?
Well, by default, Canada uses a pretty simple system. The Canadian company or institution paying the income has to withhold a flat tax rate off the top and send it straight to the CRA. For the non-resident recipient, that's usually the end of the story. It's clean, it's simple, but as you know, simple in the world of tax doesn't always mean it's the best or most fair outcome. And that's the big question, right? That flat tax can sometimes be way higher than what a Canadian resident with the exact same income would pay. Think about it. Imagine your future client is a retiree living abroad with just a small Canadian pension. That flat withholding rate could take a huge chunk out of their income. This is the exact scenario that Section 217 was designed to address.
So how do we fix this unfairness?
Well, the answer is right there in the Income Tax Act. It's a special provision called the Section 217 election. In plain English, this election lets your client raise their hand and say to the CRA, hey, forget that flat withholding tax for a minute. For this specific income, I want you to treat me as if I were a Canadian resident. This is huge. It opens the door to using Canada's graduated tax brackets and claiming all sorts of valuable tax credits, which more often than not results in a tax refund. This slide really lays it out perfectly. On the left, you have the default system. A fixed percentage is taken, no questions asked. On the right, you have the Section 217 election. It's like a key that unlocks a much more detailed and often more favorable calculation. The goal is simple. If the tax calculated as if they were a resident is lower than what was already withheld, your client gets that difference back. That's the refund.
Now here's a crucial point I want you all to remember. This election is not a free-for-all. It only applies to very specific types of income, which you can see here are mostly related to pensions and retirement funds. Things like Canadian rental income or dividends from Canadian stocks, nope, they're not eligible for this particular election.
So we know what it is, but the real question you'll face in practice is when should you use it? Deciding whether to make this election for a client really just comes down to a straightforward cost-benefit analysis. You just have to run the numbers. And the process is really as simple as it looks here. First, figure out how much tax was already withheld using that default flat rate. Then, you basically prepare a what-if tax return, a pro forma return, to see what the tax bill would be using the resident rules. If that second number is smaller, bingo. You make the election and file the return to get your client their refund. Okay, so you've run the numbers, the election is a go. Now it's time to actually file the return. The process itself isn't terribly complicated, but you have to be meticulous. You have to get the paperwork exactly right. Think of this as your checklist. First, you have to literally write Section 217 right at the top of the tax return. It sounds basic, but it's essential. And then, crucially, you have to complete and attach these three schedules, A, B, and C. Forgetting these is probably the #1 mistake people make, and trust me, it will grind the whole process to a halt and just delay your client's refund. Okay, everyone, pay close attention here. This next part is arguably the most critical piece of the Section 217 puzzle, and it's where a lot of people get tripped up. It's all about how your client's total world income impacts the whole calculation. As you'll report on Schedule A, world income is exactly what it sounds like. It's your client's total income from every single source, both inside and outside of Canada. Now, you might be thinking, why does the CRA care about income someone earned in, say, the US or the UK? Well, they care because this number is the key to determining whether your client can claim the full buffet of federal tax credits, and that's where the real savings are. And this is the magic number, 90%. The CRA applies a simple test. Does the eligible Canadian source income make up at least 90% of your client's total world income for the year?
The answer to that one question will either unlock the full value of federal tax credits or it will limit them significantly. Let's look at a clear-cut example where this works out perfectly. So, your client has an $18,000 Canadian pension and only about $1,000 of other income from various sources. Their total world income is $19,000. So you do the math. The Canadian part, $18,000, divided by the total, $19,000, is 95%. Since that's over the 90% threshold, they pass the test. They can claim the full amount of federal non-refundable tax credits, which is going to maximize that refund. But now, watch what happens if that same client also has, say, $12,000 in income from some U.S. Treasury bonds. All of a sudden, their world income jumps to $31,000. Now, when you run the same calculation, that Canadian pension is only 58% of the total. Because they fail the 90% test, the amount of federal credits they can claim gets prorated. It gets limited. And that will seriously reduce the potential tax savings from making the election. All right, let's bring it all home. We'll wrap up by summarizing the really critical action items and, of course, the deadlines that you absolutely must have burned into your memory for your clients. These dates are non-negotiable. Now, any tax owing is still due by the standard April 30th deadline to avoid interest, but look closely at the filing deadline for the return itself. It's June 30th. If your client misses that date, the election is completely off the table for that year. It's non. That initial withholding tax that was taken becomes their final answer. No do-overs. At the end of the day, it all boils down to this one simple principle. The election is an optional tool. It's beneficial if the tax you calculate on the return is less than the tax that was already withheld. It is never automatic. Your value as a future tax advisor is in doing that comparison to find the absolute best outcome for your client. So I'll leave you with this question to think about as you go through your studies. For which kind of non-resident client is this election not just helpful, but absolutely critical? The answer, as you'll find, is the client whose income is almost entirely from Canadian sources, especially if that income is relatively low. They are the ones who are most likely to be overtaxed by that default flat rate system. Identifying that client is where you can provide immense value. Thanks for your attention today.